If your mortgage renews in 2026, what I'm about to show you could save you thousands or even keep you in your home. Because millions of Canadians just went through this in 2025, and some of them weren't prepared. In 2025, Canada faced one of the biggest renewal waves in history. Payments jumped up by hundreds or thousands of dollars overnight, amortizations were stretched back in years, putting people backwards, and banks got a lot more strict on how they're handling renewals and mortgage applications. But buried inside all of the pain were three critical lessons that can protect you if you learn them now before your own renewal hits. So in this video, we're breaking down what exactly happened in 2025, why some homeowners came out fine and others didn't, and exactly what you need to do in the next 30 days to protect yourself. Let's get started with the big picture. According to the Bank of Canada, around 60% of all mortgages in the country are coming up for renewal between 2025 and 2026. That's over 2 million households. Most of those loans were written during the pandemic, when 5-year fixed rates were as low as 1.5% to 2%. Fast forward to 2025, and those same borrowers are renewing at closer to 4% or higher, some at around $389 or $399 if they're lucky. And while the Bank of Canada did just trim their overnight rate by 0.25% for variables, renewals are still landing much higher than those pandemic lows of sub 2%. Bank of Canada data shows average payment increases hit 10% across pretty much all renewals. That's an extra $250 to $300 on average per month for most families. But for those who locked in during 2020 and 2021 at those rock bottom rates, the shock was even worse, increasing by 15 to 20% in some cases, roughly $400 to $600 or even thousands of dollars per month. So yeah, it was a bit of a gut check for most homeowners. Now, most people think they understand how renewals work, but what happened in 2025 exposed a few traps that caught hundreds of thousands of Canadians completely off guard, and it's still active right now. Here's what I mean. First up, the variable rate gambit. Through 2022 and 2023, a lot of Canadians, roughly a third of new borrowers, took variable rate mortgages or switched to them. And to be fair, on paper, that seemed like a smart play. But here's the catch. Timing and structure matter more than the actual interest rate. According to the Bank of Canada data, while many fixed-rate borrowers renewing in 2025 saw payment raises of 15 to 20%, some borrowers with adjustable variable rate mortgages, meaning their payments change with each rate movement, actually started seeing their payments come down slightly as rates began to ease in mid-2025. And due to their payment being able to move, it allowed them to plan for higher payments, avoiding payment shock and seeing their payments go up dramatically because they went up gradually over time. Now, when it comes to variables, this all sounds like a win, right? But this isn't the whole story. For tens of thousands of homeowners, the type of variable product they were in, the so-called static payment variable or traditional variable, turned that bet into a slow-moving disaster. See, in a static variable, your monthly payment stays the same even when interest rates rise. It feels good at first. No payment shock, no change to your budget, but behind the scenes, the math starts to break down and crumble. Each month, a bigger portion of your payment goes towards the interest instead of principal, and once rates rise high enough, your full payment doesn't even cover the interest anymore. And this is where you can hit what's called a trigger rate, where you have to make a lump sum payment towards your mortgage or increase your payments to get yourself back on track. Now, if you don't hit your trigger rate, or if that's not enforced, after this point in time, every single month your balance can actually grow. It doesn't shrink, or the lender can extend your amortization. You're paying your mortgage faithfully, but the amount you owe to the bank is either staying the same or getting larger. That's called negatively amortizing your mortgage. Now, I'm going to give you a real life example of a file that came across my desk. I'm going to change some details and stuff like that for privacy, of course. A couple had been in their home for about 15 years. They originally took a 30-year amortization, and over time, they paid it down steadily. By the renewal in 2023, they had 15 years left, and that lined up really nicely with how they want to retire in 10 to 15 years. But they took a static payment variable mortgage with one of our major chartered banks. As rates climbed, their payments didn't change, and unfortunately, the bank never enforced the trigger rate. Now, on paper, it looked like nothing was wrong. Their payment was the same, they weren't missing anything, and life carried on. But when renewal time came, they got hit with a brutal surprise. Their effective amortization had ballooned from 15 years all the way back up to 27 years. That means almost a decade and a half of progress completely gone. Worse, when the bank went to renew them, because of their policies, they could only offer a 15-year amortization if they wanted to stick with a straight renewal, getting the best possible rates, not that stretched out one that they'd been operating under. Overnight, their payments jumped by thousands of dollars to a level where they simply couldn't afford it. They came to us in panic mode. They'd never missed a payment, but the renewal terms were unaffordable. We ended up refinancing them with another lender, extending their amortization to 24 years, which was the minimum we could go. They had to pay legal fees, appraisal costs, and stuff like that to move the mortgage. And it just kind of set them back. That move kept them in their home, but it set their debt repayment schedule back by nearly a decade and cost them more interest and costs overall. And here's the frustrating part. This wasn't a rare case. The big banks with static variable products, CIBC, TD, BMO, RBC, all of them pretty much except Scotiabank, saw hundreds of thousands of mortgages hit trigger rates during the rate hikes. Most banks quietly extended amortizations instead of forcing payment increases, and it kept defaults low, but it pushed the pain down the road. It was basically a Band-Aid. And then when people came up for renewal, they had to face that pain. So yes, variable worked for some, especially those with adjustable payments. But for static payment borrowers, the damage built up slowly and showed up all at once at renewal. So if you're renewing a variable in 2026, here are the questions you need to ask yourself right now. Do you actually know what type of variable rate mortgage you have? Are your payments covering both principal and interest? And if they're not, what happens when you renew? Because waiting to find out renewal can be very, very expensive. Now, that couple I just told you about, they weren't alone. When renewal season hit in 2025, the numbers told a much bigger story. According to the Bank of Canada, the average mortgage payment increased, as mentioned, by 10 to 15%, which is manageable for some, but that average hides the extremes. In higher cost markets like Ontario and BC, payment jumps of 20 to 25% weren't uncommon. And for households already stretched thin, that was enough to push them past the breaking point. CMHC data shows delinquencies rising, and more importantly, renewals requiring restructuring spiked. Not because people were irresponsible, but because they had no idea how far their amortization had slipped until it was too late. And here's what really gets me. Most of these homeowners thought they were fine. They were making their payments on time every single month. No missing payments, no red flags. But behind the scenes, their mortgage balance was growing and nobody told them. The banks weren't sending early warnings. They weren't saying, hey, you've hit your trigger rate or your balance just grew by $15,000. For most people, the discovery only came with the renewal letter showing up. So here's the hard truth. Your lender isn't actively managing your mortgage for you. They're processing your payments and waiting for renewal time, and generally that's about it. They're not monitoring your amortization targets. They're not looking at forecasting your renewal risk. They're not making sure that you're still in the best product for your needs. They just do what they need to do and move on. Which means if you've got a mortgage coming due in 2026, you can't afford to wait for your renewal letter to tell you that there's a problem. And of course, all of this, the variable rate gambit, ballooning amortizations, payment shock, set the stage for how banks reacted in 2025. They saw risk and they adjusted accordingly and quickly, which leads us into our next lesson. Banks changed their playbook in 2025 and will probably change it further in 2026. Many borrowers discovered that the renewal is not just an automatic yes. If you've missed payments, if your debt servicing ratios no longer fit the stress test, your bank technically can say no and force you to find another lender. TD economists forecast unemployment peaking at 7.3% in late 2025 and continuing through 2026. And renewal defaults rose with that. That means lenders tighten underwriting across the board, which means stricter guidelines, sometimes higher rates, and sometimes shorter amortizations. And here's the kicker. Some banks refuse to extend amortizations they'd quietly stretched during the rate hikes. And that's where borrowers get stuck with payments they can't handle and nowhere to go, pushing them to alternative or private lenders at significantly higher costs. So the takeaway here is simple. Never assume your lender is taking care of you. At renewal, your file could possibly go back through the machine, so why not have it go back through the machine already with someone like a broker to shop the market for you? If you don't qualify under current rules, at least you'll have those ideas and know what you're looking at. And that way, if the bank says you need to find a different lender, you can build a different strategy around that. And to be honest with you, you don't want to be figuring all this out a week before your term expires because you will never have enough time to do it. Start early. It's key. It's important. Make sure you're starting like 6-9 months out. So let's talk about the 2026 renewal crowd. The good news is we're in a declining rate environment. Most major banks expect the Bank of Canada to continue cutting rates further through 2026, though not as aggressively as they did in 2025. And with 5-year fixed rates possibly sliding down lower than 4%, that means you have some good opportunity if you set yourself up right. So here's your checklist. 1, start early, 6 to 9 months out. Pull your mortgage statement, check your balance, remaining amortization, rate type, all the different details. Don't wait until 60 days before renewal. That's just simply not enough time for you to shop the market, which leads into the second thing. Compare lenders. Different banks interpret renewal risk differently. Some offer better rates and some offer harsher clauses. You're going to want to make sure you explore all your different options available to make sure you're getting the very best mortgage for you and strategizing so that as rates come down, you can benefit from them. Number 3, watch for penalty traps. The big 6 banks like RBC, CIBC, Bank of Montreal, they carry some of the largest interest rate differential or IRD penalties in the industry. Another thing you really want to watch for is something called a bona fide sales clause. With that, you'll commonly get a lower interest rate, very slightly lower, but it is basically the equivalent of a mortgage headlock. If you want to move to a different lender to access better rates or options, both of these situations limit your ability to do that, if not eliminate it entirely. Number 4, check for negative amortizations. If you're in a static variable, ask your lender for an updated amortization schedule as soon as possible. If you've fallen behind on principal, this is going to let you know exactly what things are going to look like so you can prepare for renewal and have that understanding that you may have to extend your amortization to keep your payments where you're comfortable. Number 5, and this might be a little self-serving, ask a mortgage broker for advice. Mortgage brokers have access to over 40 to 50 different lenders, banks, credit unions, monolines, and know which ones have favorable renewal policies, and they can shop the market so you don't get boxed in. The bottom line in 2026, you want options, flexibility, and you want to start early and get good advice. The market will still be volatile, and the biggest lesson from 2025 is that people who started early had choices. The ones who waited generally got stuck. I've been helping families navigate renewals all year, and that's been the difference every single time. Early planning always wins. If you're renewing in 2026 or beyond, don't wait. You can book a free strategy session call with myself or my team. I'll make sure to put the link in the description down below. And let's make sure your next term sets you up for success instead of surprises. If this video helped, do me that favor and hit that like and subscribe button. And drop a comment down below letting me know your mortgage renewal questions. I'm going to read through them and try and answer every single one. Thanks so much for watching. My name's Myles Nowik of the Nowik Mortgage Team, powered by Andy Mortgage. We'll see you on the next one.